What are institutional imbalances? Well, to put it in a very short term, institutional imbalances are just like our price gaps. And what that means is if you have institutional imbalances, what happens is price has moved in one direction without any retest or balance. One thing to remember in the market is that the market is like a check and balance book, just like in your checkbook or with the bank account or in accounting. So when you have a bunch of buys, so when you have buys, the buys must be balanced by sales. When price moves one way without the other, you have imbalance in the markets. So the way that the institutions, the market makers look at this price imbalance is that they want to make sure that they can fulfill orders. And they want to make sure that orders are not left unattended. So if you have price moving up here, there's incentive because price had moved up from here. Let's say if we copy this and move this down here. No, we're in an uptrend and price has moved higher than this last candle. Then the market wants to balance out that price movement by causing either a wick to happen to go back into that to create some sales to balance out those buys that made price rise, or to create a downward bearish candle, which are also sales to balance out that upward price movement. They're retesting the open movement. So if price literally just goes up, if price literally goes up here, this is equivalent to people placing buy orders. So they're placing buys and price is steadily ticking up and it's just buy, 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 buy. You have a strong green candle like this. Well, this candle is filled with buy orders. The market makers care more about balancing their order flow. And what happens is to balance that out, a lot of times, either a candle, right after it, or they come back to it later and they balance out those buys to where now you have an equal amount of buys balanced out by equal number of sales. And then let's say there's another buy. Let's say there's another buy, a little bit bigger this time. They're going to balance it out with sales. So let's say here, because if you look at here, this buy ended here, this sale balanced out this entire candle. But now you have this opening in price, this movement in price. So what the market makers would like to do, and it doesn't have to be a whole candle that does this, but they just want the orders to go down to capture those buys, to capture what was the movement in the market. So now you have this balanced here. So now the price is balanced again, and this process continues over and over again. So when you have a place in the market where the price just goes up and continues to go up, then you have what's called imbalance because price didn't go back down to balance out that price action. Now you have this entire area here, let's make this white, this entire area here of upward price movement that didn't have any sort of retest or balance to it. So in this example below, you're in an uptrend, price goes up, there's some rebalancing that happens, but then price continues to go up and it tries to rebalance, but doesn't rebalance the entire way, and price goes up again. So what happens is you have from here to where this wick is, you have imbalance. So you have open buy orders or unbalanced buy orders in the market. And they may take a few candles, they may take a few days, time doesn't really matter with market makers as long as the objective is complete. And the objective is keeping the market balanced and capturing liquidity. And if you want to know what liquidity is, how that really works in the market, I'm going to put a video in the description and in the card above so I can show you what liquidity is, because that's a separate lesson. But for the imbalance, price literally is left this area unattended. So what the market makers do is they either climb down here and do like a bunch of candles to get back down there, or news may happen, ironically, and you have something like this happen where either you have a full candle or they may go as far as just to wick that area. So if they go here, they may just wick that area and go down into it before continuing up. So that's how imbalance works. And let's show some chart examples, because this can be a really powerful entry area using the right method to really capture accurate prices to really place entries in. So let's look at the market. This is gold, of course. This is a trade that we were looking at, and some of our people had taken this trade. It's a really good trade. I'm going to show you exactly what we're looking at here. So let's actually zoom in just a little bit so we can see it better. As you can tell, at this point in time, gold was in an uptrend. You have price going up. You saw some imbalance happen. Price, it came back to it. And literally, you see anytime there's a movement in price in one direction, there's a soon to be movement in the other direction to balance out that gap and area, just like we talked about in the example. So when this movement happened, price had only came back this far. So what happened was it left the entire area here, that was unattended to, unbalanced. The price continued to make its movements, balancing out price on the way up, but this remained imbalanced. So what happened was price, once it made its move, started making its move down, this became a magnet for price to bounce off of. And price, what literally happened is news happened and price went right down into that imbalance. And as you can see, it rejected off of that area. And anybody who placed the trade in that imbalance is in a very good profitable position at the moment. And as you can see, there's current imbalance above where this candle is. So odds are price is going to balance out this gap, this imbalance gap in this present moment in time. So when you have these areas in price, these areas are magnetized areas. So what I like to do is identify these areas when I'm going into the market and maybe use other confirmations when price gets into that area, maybe rejection, maybe it's a Fibonacci area that gets bounced off of, or an indicator crossover after it hit that area, and that would be your confirmation for a trade. So I hope that helps you when it comes to imbalance. When it comes to a couple of things to avoid when it comes to imbalance, let's move into a different market. I could probably find some examples pretty quickly. So we can go here. let's get a bigger time frame. All right, perfect. So a bigger time frame here. So we have a 12-hour time frame. Here's what's happened here. So in this present moment, if we focus on this area here, focus on that area there, you see that, you know, you have a bullish candle followed by a bearish candle. You have this wick here, which represents upward price movement. And then price came down to balance that. Now, let's go ahead and replay this real quick so you can see. So as you can see from the 12-hour perspective, this looks like a balanced market, and there's not much more to see at this present moment in time. But if we go down to, let's go down to the 4-hour, you can see that now, since we've broken up the time shape, the time zones in the time frame, you can see that there's a different story in this area. That price in these candles, they balanced out up to here. So you see this downward movement, and it was balanced out by this upward movement. And then we got down to this area here, and this downward movement happened. There was a gap in price because this was already previous balance. This up move was balancing this down move. So when this down move happened again, this up move is not balancing this down move because it already balanced this. I mean, this up move is not balancing this down move because it already balanced this down move. So it can't balance two things. So price moves down without any sort of balance, creating this zone here, from here down to there, where this price has now came back up, balanced some of it since then. So if we stretch that out and replay, you'll notice that price wants to balance this area out. So we'll play it a little bit. You know, price moves away from it, but eventually it'll come back to it. You know, like I said, the market makers, they'll take their time, but they're going to hit it. So there. So you have a little bit of it hit right there. So if we adjust to the new price movement, yeah, you could have probably had an entry there, which would be a good entry because you don't have to have all of the imbalance hit to find good entry points. Sometimes I like to go to half of the imbalance as an entry point. But since that happened, you have to readjust the imbalance because now part of that imbalance has been balanced. So if we continue to play, see what happens. So you have that move happen off of that partial balance. You know, that would have been a good trade there. But now the market wants to come back to that imbalance. And there, right to the pip, it hits that imbalance. Right to the pip, it hits that imbalance because the market makers don't leave money on the table. And when the market makers see that there's money on the table, they're going to come back and take it. But you can use this to your advantage to find accurate trades. So right after that has been balanced, it has a straight movement back down. That would have been a great trade. Let's say we took that trade just as an example of our short position here. Just as an example, let's say we took it right when it touched the top of the imbalance, and your stop loss would have been that last high, which would have been here above that last high. It had a 15 pip stop loss, and then price goes down 40 pips, and you have a almost 3-to-1 trade right there. Just using, proper risk management and accurate entry points. So you would have had a great area to trade, and you would be still in that trade, possibly or partially in that trade, because you had your take profit hit. and you would have had a great trade. So this is just a little bit on imbalance. If you want to know more, check the links in the description. I'm going to have relevant videos to help you further understand this. But being able to identify these things, being able to know that, hey, I may see that it's balanced on one time frame, but maybe in another time frame, it could be hiding a different story. Just like in this example, you'll find great entries. Had you just went based off the 12-hour, you wouldn't have seen anything that really happened, or it would have been harder to see. But since you changed time frames, you're able to see it clearer, find a more accurate entry, and that way making you more profitable. So this is Wall Street Moses, and I hope that you had a great time learning this. Definitely want to make you more money. Like, subscribe, comment what you learned most in this video, and I'll see you in the next one.